Good morning, traders. Today is January 8th, Sunday. This is the MENT Rotational Modeling System update, and we're going to start with this SPY chart weekly, SPX chart weekly, and gold down here. And what I want to highlight is that what I believe is actually happening is the 2003 and 4 type of setup, which, even though this chart doesn't go all the way back, I'm going to highlight it right over here, which is basically this range right here off of this base bottom. And what we're looking at is currently we've got a big base bottom over here in the SPY off of the deep pullback, and I believe we're looking at kind of an extended basing bottoming formation here, which could lead to a moderate melt up off of this low, kind of like this, maybe moving upward into this area. So what we're going to focus on is some of the telltale signs that show us this is likely to happen. And, okay, well, I guess that doesn't want to change, so we'll just leave this green. So now look back over here at 2002, 3, and 4, and how the SPX moved into an upward melt up after the 2000 collapse, rallied almost 100% during this time frame, and then stalled out. But look at how gold rallied through this cycle. And what I want to point out is the real significance of deep lows in gold and the rallying phase that comes out of these deep lows in gold. So understand that we get these rally phases here and then rally phases here. And now we've had these deep lows here. Now you can see here, this deeper correction here was a moderate correction here in 2021 that prompted a bit of a rally phase here. And then we've got this deep low here that's now rallying to the upside. So understand that each of these instances, when you actually take a look at this low occurred here. Try to get this at this point. This low occurred here, right at this point. This low occurred here, right at the COVID collapse. This low occurred right here. Try to get the actual bottom there. And now this low occurred right there and right there. So understand that gold tends to lead in a rally in the early stages of a bottom. Now understand that we have gotten into this phase here after 2002 and 3, which is where I believe really the markets are right now. It's almost replicating this 2002, 3, 4 structure, possibly moving up into a 100% reflation trade, meaning back up to near all-time highs over here on the right side of the chart. And I believe we're likely going to be seeing some kind of a big move in metals over the next 5, 6, 7 years that coincides with this deep bottom. So understand that we've had these big deflationary cycle phases, then a bottom, then a reflationary cycle phase, then a deflationary phase, then a bottom, then a reflationary phase, then a deflationary phase, then a bottom, then a reflationary phase, then a deflationary phase, then a bottom, and now a reflation phase. The idea behind this is that if my analysis is correct and we move into a new wave 5 structure, possibly up into the 5,500, 6,500 area on the SPX, we could see a massive multi-phase wave, possibly an A, B, C, D, E type of wave formation that could move metals substantially higher. So understand that from these lows here, metals moved up. Oh, got the wrong one. From these lows here, metals moved up. And this is just GLD. This is not the actual GC chart. Gold futures moved up 171%. So from this point over here with gold at around 1800, if we were to move up almost 200% from 1800. That would put gold up in the 55 to 6,500, maybe $7,000 range. From the ultimate lows way back over here, if we talk about 2002 and 3, when we drag this back over to these lows, we're talking 340+% higher, which in the futures contract was even bigger. And that would put gold up in the 11,000, 12,000 range over the next 5 or 6 years. So if my analysis is correct and we're in this cycle phase and this rally in gold and silver continues, we are likely going to be entering into, I'll drag this out, we are likely going to be entering into a reflationary cycle phase, which could put us into a very solid upward trending. You can see I've already drawn some target levels here. And where I believe we're really going is, let me do it with this, into this area here. And I believe that ultimately we are going to be rallying up into this phase from this low, rallying back up into this area around this high, and then roll higher up into 2025, 26, 27, and then start to roll downward. And that's ultimately what I believe is going to happen based on what we're seeing in the market. Now, there's a lot of conflicting data. A lot of people out there are telling you that, you know, the market's going to go lower, that we're going to see deflationary cycle trends. Look, throughout the rest of the world, you know, excluding the US and possibly Europe, yes, we are going to see some extended deflationary trends as debt and credit continue to unwind and the excesses continue to unwind. Even in the US, we're going to see a wave of foreclosures and bankruptcies taking place because the extended global pressure is going to weigh on the US over periods of time. But as long as the US economy continues to function, as long as the US consumer continues to function, then the reflation trade and the strong US dollar continues to stay above, say, 99. Really, I think it's going to stay above 102, 103, at least for the next 6-7 months. Maybe weaken a little bit towards the end of this year, but as long as we continue to see some lack of crisis catalyst event, then I believe that we're going to see this reflation trade moving into 2025, 26, 27 peaking area, and then potentially roll over into a broader crisis event. So this is the big picture that I want to point out, is that there are a lot of people out there talking about how this is going to collapse. And in my opinion, ladies and gentlemen, I've already drawn this box way out here. Let me try to show you a bit of a bigger, longer term time frame and redraw these a bit more effectively. So in reality, ladies and gentlemen, we have the potential for this base bottom to consolidate, moving into potential sideways activity, possibly getting up to new highs, and then rallying up to new highs over here before rolling downward. Now, the downward rotation I've drawn in this box, this is the cycle phase peak right here. So somewhere in this time frame, from 2027 to 2030, roughly, we could be looking at an extending top, rollover top type of formation, which would essentially be an excess phase peak. The way this top would work, let me get rid of these lines, is it would form a peak, it would roll downward, form a flag, roll downward, form a base, which would become a sideways base level, consolidate around that base for 5, 6, 12, maybe 18, 20 months, and then break downward. And at that point, I think where we're looking at is the potential of a downside move into this area off of these recent lows. So I'm going to try to draw some horizontal lines here, and or the midpoint area of COVID, which puts us right around there. So ideally, Once we get to this phase, this is the end of wave 4. I think we're going to be looking at a downward cycle that could be somewhat like this. And then eventually somewhere into this area as a downside move. Now that would be about a 55% decrease in the SPX, which oddly enough is very, very similar to the 2008, 2009 decrease that takes place. What we're looking for right now, ladies and gentlemen, is we're looking for this new reflation cycle trade to take place over the next 4, 5, 6 years, and then prepare for this down cycle move after 2027, 28, 29. Okay, now gold could rally 300 or more percent from this low. So do a quick math, 150 plus 450 puts us at about 500, 525, and that means we could be looking at a rally from these lows in gold up to about here. And understand that that would be a very substantial rally in gold. The actual blow-off peak would occur back over in this area, maybe towards the end of 2028, 29, 30. And that blow-off peak, believe it or not, could actually be higher than what we saw in 2008, 2009, and could push gold up above $12,000, $15,000 an ounce. So we are at a very exciting time. Metals need to be on your focus. If my analysis is correct, we're moving into a reflation trade. And let's go over to the rotational modeling system data. First thing I want to highlight is the volatility index. The volatility index weekly is moving into slightly positive territory. I've been highlighting this for many, many weeks that this downward cycle is nearing an end. I called this a wave 4 bottom, looking for a wave 5 breakout, which would move us up here into the 12, 13, 14 area. That would move us back into bullish trending. We're seeing quite a bit of strength here, even through the end of 2022. You can see here from this is basically the October lows. We've seen quite a bit of accumulation here, bullish trending from down here below 6 all the way up above 10, 11, and now we're holding up quite well. If we continue to see reflation upward, we're going to see this move above 10, 11, 12, 13 into real strong bullish trending. Okay? Now, if we move backwards, oops, wrong one. If we move over here to the rotational modeling system, the rotational modeling system is still bullish on the weekly chart, SPY, which we allocate 25% of our allocation to, and bearish on the daily, which we allocate 75% of our allocation to. That nets us into a 50% bearish position, 50% cash. When the markets move out of this sideways consolidation and attempt to move higher, this daily system, which is fairly close, maybe a week or two away from moving back into bullish trending, is going to put us back into 100% cash. And during this reflation trade, we may get some mixed daily signals, but the weekly signal will likely stay bullish. It has stayed bullish since 6/10/2020. This is all prefaced on the fact that the global central bank and the U.S. Fed are going to try to navigate global economic concerns without prompting a crisis catalyst event. So we need to be extremely cautious of unknown or unforeseen crisis catalyst events over the next 5+ years. And this means that we have to stay very, very cautious as to how we address the markets, and we need to watch for the underlying cycle trends to take place. Now we have let me just come backwards this way. We have our allocation levels are set up almost perfectly. 20% stocks, mean you can still trade with a small portion of your portfolio, 55% cash, and 25% metals. Our hedge in metals has played out extremely well. Yeah, we were under some pressure for a while, but I want you to understand that the hedge, the strength of the US dollar, and the strength of metals, the way it's performing right now, has really worked in our favor. We have avoided risk for much of the last 16 months. We've stayed actively protected throughout the last 16, 17 months in metals. Metals have continued to perform very well. Even last year, I believe metals performed much stronger than the U.S. markets. And we were actively protected in the U.S. stock market as of August 2021. Now we're starting to see some strength in XLP, consumer staples, silver, gold, Dow Jones, and mid-cap 400. Once this flips into more strongly bullish trending, we'll start allocating more money into stocks. We just don't have that confirmation right now, and that's going to put us back into a bullish trend cycle phase. The long-term success of the rotational modeling system is really hard to argue. We lost 0.60% last year in all of our trading. We took about, I think it was 9 trades or 10 trades. It's really not that destructive compared to what you're going to see at the end of the year with regards to hedge funds, banks, and managed funds. You're going to see a lot of them with minus 20, 30, 40% or more. And you need to be aware that in order to try to grow the wealth the way this does, we have to be able to take some risk in our trading activity, but understand that these consistent positives outweigh these negatives considerably. Over the last 26 years, we've had 3 negative years. Well, the worst one was 2011, but understand that we've had 3 negative years over the last 26 years. That's like a 97% success rate. And we've seen the equity more than 500% more than the SPY. You see here, we're at about 600,000 here. We're at close to 2 million up here. So it's actually about 380, 360% more than the SPY. And the next couple of years could send this well above 2.8, 2.9 million. Okay, now, rotational, we don't need that. What we need is this. The metals trend index, this is my proprietary custom metals trend index, has shown that metals have accumulated quite strongly to the upside. We're very close to new all-time highs again. I wouldn't be surprised if we see a little bit of a stall over the next week or two, but then I think this appreciation cycle is going to move us up into new highs. This means the price of gold and silver will likely be 2 or 3 weeks behind this custom metals trend index. But if this gets up to new highs, then eventually the price of gold and silver will likely get up to new highs. And this will also send off a trigger in the metals markets. Once we get up to new highs, it's going to be a very strong focus for traders. And traders are really going to start paying attention to what metals are doing when we get to new all-time highs again. And let me come back over here. And I'm in the wrong one. Hold on, guys. Come back over here. Come back over here. There we go. Okay, now the Innovation Index weekly chart shows that the innovation sector, which includes technology, the ARC funds, pretty much all of the new technology sector, which really had a big speculative phase after COVID, has now based and bottoms, getting very close to turning around, and a reflation trade may see a good solid from 50 down here up to 100, which would be 100%, 80 to 100% reflation trade. So I need you to be aware that if my analysis plays out well, one of the best sectors you're going to see for some sort of a reflation trade is likely going to be healthcare, biotech, defense spending, technology, innovation. This looks like it's got a really solid potential to get back above 70, 80 fairly easily, maybe even 90, 100. And from where we're at 48, this would be a 60 to 100% reflation trade to the upside. So we're waiting for confirmation of this, and it will come in the TT Scanner hot list. So pay attention on my website to the TT Scanner hot list. That's where you're going to see a lot of these trades set up for weekly swing trades. We've seen a complete devaluation of this sector. We've now gotten back down into pre-COVID substantial lows. That's in this area right over here, 40, 41, 42. And once we reach, or if we continue to consolidate here, I think we could see a very solid reflation trade back up here into 70, 80, 90, maybe 100. Next, we have the fear index, the SPY here in the middle, and the market sentiment index. The market sentiment index is basing, bottoming, and starting to show some real upward trending. The SPY may follow through. We need to see the SPY get above this 410 level to see some real confirmation, but that next move could be very explosive. And it may happen here over the next 20, 30, 40 days. We have earnings coming out. We have expectations coming out. We have the new bill that was passed by Congress, the Inflation Reduction Act. We've got a lot of new impulses in the market that could come to drive the trend much higher, which will drive the fear index back down below 6.5, 6.6, and that would put us back into very solid trending. See here how during this upward trending phase, the fear cycle dissipated, took a while for it to really consolidate, and then it moved into this extreme low trending. Once we get into this extreme low trending, right down in this area, remember, we hadn't seen real growth here. Once we get above this moderate cycle phase over here, we start moving into the 370, 375 area, you're going to start to see some real solid appreciation over here. But remember, I'm telling you, the overall cycle phases were very similar to 2003, 4, 5, which means that we're going to see a potential reflation trade back up into these areas, and then we're going to run into some resistance and roll over a bit and then come back up. So where we're at here, going to rally up to about 460, 470, maybe 450, stall a bit, attempt to get above these new highs at 480, 483, then roll back down a little bit, and then really begin to accumulate into an expansive phase. I believe that's going to be like 2024, 25, 26, somewhere in that time frame. But again, we're seeing very solid basing and bottoming. What I want to point out here is that each of these deep, deep lows has been down below this lower cycle, and we got down below this lower phase right here. This, I believe, was the ultimate bottom. This is like the October time frame, and now we've seen this rally back out of it. We could see another wave down. You can clearly see an A, B, C. We could get a D, E phase back over here, another washout low. But I believe we're moving into a reflation phase. Now we need to see if it actually comes to fruition. Okay, real estate is weaker. Let me come in here. Okay, next. This is the metals trend index I showed you. I showed you these. Real estate is shifting. This is one area we have to watch for a potential crisis mode. Real estate could continue to devalue, which could put pressure on banks, financial institutions, and companies like Airbnb, Redfin, Zillow, you name it. But we do not see that yet. The Fed will likely try to avoid this crisis from repeating itself again, and will try to navigate a fairly soft landing. But real estate's likely to fall another 20, 25, 30%. And then we go back to the custom volatility index, which I'm expecting to continue to kind of flatten out and attempt to move up above this 10.6, 10.8 level through through January. Remember, earnings are about to hit, and we're going to have expected earnings for the first half of 2023. I believe that we're going to see moderately strong earnings, even if they're downward revised a bit. I believe we're going to see moderately strong earnings, and as long as the consumer and the economy holds up well, we could see a moderate reflation trade over the next 24 to 36 months. So get ready. Could be very, very exciting. I'm going to leave you back with this chart, and I want you to be aware of the fact that as long as we see gold continue to attempt to rally upward, we are likely in the very early stages of a base or a bottom, which may last until May, June, July, before we get some real momentum to the upside. But then we rally back up to the the 47.50, 47.60 area, stall out a bit, and then attempt a multi-leg advance up to 57, 5800, maybe even 62, 6300 before we reach the peak in the markets somewhere in 2029, 2028, 29, 30. And that's my interpretation of where we're at right now. Get ready. The next 3 to 5 years are going to be very, very exciting. And remember, follow my TT scanner data, because we're going to see a lot of triggers over the next 6, 10, 12 months, generating some huge returns if I'm correct. All right, guys, follow me on Twitter. Share with your friends. Share with your family. Let them know what I'm doing. And remember, I was well ahead of this move. And again, I don't want to be harping on the negatives, but everybody thinks this is 2008, 2009 all over again. And I'm trying to tell you that this is vastly different. We're in a totally different world. In my environment, we're post, there's the way I see it is we're post 1930, the massive speculative phase that took place. And this is now actually 1945, 50 area. And we're getting ready for a massive expansion phase. Now, remember, we had some downward cycle trends in the 60s and the 70s before we started this massive expansion phase in the 80s, 90s, 2000s, and so forth. So what I'm seeing is we've seen a ton of money printed. We've seen some exorbitant speculative phases which need to continue to unwind. But in my opinion, I think we're really near the 2003, 4, 5 area. We're looking at a reflationary cycle phase to an ultimate peak where we will have a correction. That will be very, very similar to a reset event. And that will then prompt the next 60-year event cycle to move onward. I may not be here for that, but I'm going to show you how you can profit from it along the way. All right, guys, talk to you soon. Good morning, traders. Today is January 8th, Sunday. Took a while for me to get all this data together, and I wanted to make sure that everyone got a good update as we start the new year, 2023. This is the MENT.com custom real estate analysis algorithms that I've created, and they show a very interesting cycle setting up. So let's start up here with this top chart, drag it down a little bit. You can see that median listing price, this blue line, is kind of flatlined. Markets are digesting what is taking place. We had a little bit of lower interest rates over the last couple of weeks before the Fed raised interest rates. Again, 50 basis points. That has not been reflected in the data yet. We have seen tremendous amounts of price reduction. That's this yellow line here. You can see we went from very strong pricing pressure, negative price reduction data, meaning prices were increasing substantially. Now we've gone to almost full 100% and beyond price reductions. They've dropped the last couple of weeks towards the end of last year. And remember, this does not reflect anything into early this year yet. This is just basically end of last year, last 2 or 3 months of last year. But you can see from October, November, December, which is this last little bit of data here, we have inventory skyrocketing. We now have probably at least 5-6 months worth of inventory. We've got price reduction share holding up in a positive manner. We've got median price listings dropping. I expect it to go into negative territory by April, May, June of next year. We have median days on market staying still rather positive, inching higher. I believe that's going to continue to inch higher again as more inventory floods into the market. You're seeing the Uber, not Uber, but Airbnb and the flippers really get price squeezed right now. A lot of these people are have bought homes in the middle of end of next year, flipped them, tried to upgrade them, and now they're flipping them. And you're going to see these price reductions continue to skyrocket. And until the Fed moves away from raising interest rates, which may come sometime later this year, they may get a little bit more dovish. They may continue to push rates a little bit higher trying to stop inflation. But real estate has changed dynamics completely. You can see days on market shot up here during COVID, but we had negative pricing pressure and negative active listing count. So they were basically, the market was super hot. It got even hotter right back over here, okay, with extreme pricing pressure right up here. Now we've seen the dynamics change, but we haven't seen price really move lower. We need really to see price move lower, and I expect about a 20 to 25% decrease in price. Now, my modeling system shows we had a little bit of an uptick at the end of last year. You can see we had gone up 3.72% in the real price factor, meaning the prices were holding up, still negative, but were holding up better. And model market demand had gone up 6.2%. I read an article that sellers are now having to become very creative to get buyers to engage, covering costs, providing money, discounts for potential upgrades and repairs and things of this nature. So you're still seeing people buy. And I assume what is actually happening in this type of scenario is it is the people who have sold out of a house over the last 12, 18 months trying to get into something as prices start to depreciate, so to say, for real estate. So we're going to still see buyers come into the market, but it's going to be once the actual trend shifts to the downside, like we've seen it come down here with pricing pressure and days on market and actual inventory. Once it actually shifts, then you're going to see buyers start to demand more and more concessions from sellers. It's just going to be a matter of time, and the Fed's putting enough pressure on everybody to move in this direction. We're seeing reductions. We're seeing extended active listing counts. We're seeing extended days on market. This is likely going to shoot up, possibly in excess of 20, 30, maybe 40 days average day on market. And you're going to see this continue to roll higher. Like I said, I expect real estate to move about 20 to 30% lower from where we're at right now. Okay, the dynamic price trends are flattening out here. You can see at the end of the year, we've seen some reduction in dynamic trend, but it flattened back out to the upside. Real estate reduction activity has kind of stalled back out. We had a big wave of price reduction activity here. Still seeing it move higher in regards to share of market. But again, this is a price reduction activity. What's happening is prices are attempting to hold up right now. This is kind of like the last line of defense before we start to see some increased reductions activity again. So, you know, the way you look at this is that this measures kind of like, think of it as putting your foot into the gas pedal of reductions. That's what we saw here. Huge increase in price reductions. Everybody stomped on the gas as far as reducing prices as Fed was raising interest rates. Now we've seen it roll back lower and stall out. People are trying to defend the price level where we're at right now. People are essentially waiting on the Fed to see if they're going to see some sort of a pivot. And we're seeing the markets kind of slide into this moderate reduction period. Active real estate listings have peaked out again. We've had a big influx of real estate listings here. I would expect this to continue to roll a little bit downward in January and then roll back up to the upside as we start to move into more listings being pushed onto the market. New listing count metrics, you can see here, new listing count is the highest we've seen in quite a bit of time. This is going back to 2018. New listing count change is, you're seeing here, count change is minus 0.64, and new share of market is minus 0.2. So we are seeing listings kind of roll over right here. So we're seeing a bit, I mean, we're at a pretty high level, highest level we've seen in 2 years for new listings. It's very likely that this is going to roll back down here to around 0, maybe minus 2, minus 3, plus 2, plus 3, and then roll back up as sellers are forced out of the market and we start to see new waves of foreclosures. That's what I think is going to really push the market into a downward price cycle. I think there's going to be people very active in trying to get the best price they can right now. Next, we have the real estate heat rank. real estate heat rank has dropped. I mentioned this last week that we had gotten into this kind of a end of year stagnation. It wasn't really super positive. It had gone from negative up to slightly positive, and now we're back down into negative heat rank. That means that the market is cooling substantially. The tightness rank is tightening back up. We saw the loosening of the market here. This is an indication that the market got very weak, and you can see here that we've tightened back up. We're back up into a fairly tight range here, and I expect it to move back downward into this minus 60, minus 80 area as a new wave of selling hits that may come in January, February, March, I would expect, if not in the second quarter. Inventory strength is rolled over. You can almost draw a line right across these areas here. This would indicate that inventory strength would weaken again. That would be another wave of price reductions. That would push the tightness rank back down into minus 40, minus 50, minus 60. And this would push this wave of selling here, this price index wave, possibly down into minus 10, minus 20. And it would be the first real indication that the real estate market has broken downward, that we're not seeing appreciation in the market. And then, of course, you see seller desperation here. So I've inverted this to try to show you what was going on in seller desperation. Okay, we have a scenario here where sellers became moderately desperate, and then there was a weakening of desperation. We saw a weakening of desperation. I expect this to change direction and move into a very strong seller desperation mode. This is essentially a scenario here where, because of the moderate strength over the last 2 or 3 months in real estate, even though there was not a lot of activity, and the activity that we did see probably came in metro areas where stronger price appreciation is still holding up, we are seeing kind of an end of year blip here. And I believe in the early portions of 2023, it's all going to roll into the negatives. So now let's take a look at my new custom real estate cycles index. And I want you to see here that the deep bottom in real estate occurred through a consolidation congestion period through 2007, all the way across to this low here. This is average U.S. home price levels. And now we've seen this move from approximately 140,000 all the way up to 425,000. Do I expect a downward cycle to possibly come down into this 140, 150 area? No, I do not. I think that's unreasonable. I think the real cycle trend here is going to end somewhere around 220, 240, 250 down in this area. And I believe that's going to prompt a move roughly down into this 260, 270 area, down in this lower standard deviation channel. And that's what we're looking at for the real estate cycle over the next possible 3 years. Now, it's going to take potentially 3 years to unwind the excesses of the market. But this upper chart is my, let's call it the custom real estate, call it a fear index or an environment index. So we have extreme optimism, extreme low interest rates, extreme buyer activity here, meaning that we're seeing a very low boundary of entry for buyers. This means it's really easy to get in, prices going up. It's like a super easy market to make money in. This is a very difficult, hostile environment for real estate way up here. We've never seen anything up at these levels. This is extremely hostile. So pay attention to the peak back over here in 2007. This became very, very hostile. This was the prior to the global financial crisis, and this led to an unwinding of excesses for the financial system. Now, I don't believe that the financial system is going to come under pressure here. They could come into some moderate pressure. What I believe is going to come under pressure are the flippers and the Airbnb and the Redfin and the others that are involved in this superheated market. In other words, this became an ungodly period of extreme optimism in the market, and then it shifted from extreme optimism. the most optimistic market conditions we've seen in literally 25 years to extreme hostility up here. And I think this is going to trap the market once it finally does break, pushing this level back down into these lower areas here, okay, eventually 2-3 years down the road, and causing pricing pressure to move into an extended downtrend, possibly trying to restructure around this area, which is where I get my 200 to 250 average price range for U.S. housing. That means that hypothetically we're going to see about a 30 to 35% drop to the downside. Now, I will highlight this indicating that the markets are moving into a slight reflation trade. Now, I do believe that we're basically in a 2003 market cycle, okay? 2002, 2003 market cycle. So if you were around in 2002 and 3 and you were investing in 2002 or 3, you understand that it was a broad unwinding of the dot-com bubble, the 9/11 terrorist attacks, and the markets basically stayed in a sideways channel for about 5, 6, 7 years until the 2008-9 global financial crisis. And I believe we're in a similar type of scenario, indicating that the U.S. markets could find some strength, maybe dip a bit lower down to these mid-COVID lows. This is the SPY here. We are seeing a very low fear or weakening fear right now, so I believe 2023 could see the U.S. stock market attempt to push a little bit higher, just a little bit higher, maybe into this 440, 450 area. Eventually, it's going to try to break these highs, but I don't really see that happening in 2023. What I see is assets moving away from speculation. So that would mean cryptos, Bitcoin, collectibles market, real estate. I think we're going through a great revaluation period, which may last 2 or 3 years. Now, we may get a bit of a reflation trade in the U.S. stock market. Certain stocks, for example, technology, I think may see a 20-25% reflation trade. I think innovation may take and see a 20-25% reflation trade. I don't believe that real estate is getting anywhere near a reflation trade yet. I believe that real estate is going to continue to unwind as these excesses that I showed you before, these excesses in price structure, we've gone way above standard deviation channels. And in order to get back down to normal, we need to get down here around 290, 270, right in this area. From where we're at right now, that's a $100,000 decrease, which is another 30% decrease in current pricing. It's more than 40% from this peak level up here. So you're going to see real estate attempt to devalue through a broad cycle phase down into this area, and it may not come until, I don't know exactly, but we might not find this bottom for another 5, 6, 7 years. That's about how long it took over here. From 2005, we came across these highs, rolled all the way down to 2012. It's a 7-year cycle. So we could see this same thing happen here from 2018. That would put it at 2025, 2026, maybe we see a real estate bottom. Understand that we have yet to move into a downward cycle. So if this is the peak in 2022, you got a 5 to 7 year cycle from there. That puts us at 2028, 2029. That could be the absolute bottom or near the absolute bottom of the market. So what we have going on here is a deflationary cycle trend. This is good for the Fed. It may prompt some moderate easing of the Fed over the next couple of years. But again, the Fed has kept interest rates extremely low. I expect the Fed to keep interest rates above 2 to 2.25% Fed funds rate over the next couple of years. So it's not going to be easy. They are going to unwind a lot of these excesses, let the market settle, and try to find some sort of a base value to move forward. And that's kind of where we're at with this whole thing. So now if we come over here, gold, just like in 2002, 3, and 4, has started to really appreciate. And this is something I want you to be aware of. In 2002, 3, and 4, gold was like the most underappreciated hedging instrument ever. We had seen the dot-com rally. Everybody was trying to bet that the dot-com rally was going to find a bottom and move back up, just like everybody's doing with Bitcoin right now and cryptos and others. Yeah, there may be some sort of a reflation trade that we see, but you need to be prepared for the next 4 or 5 years for the markets to struggle to find a bottom. But gold, silver, platinum, if my analysis is correct, is very early in what was like a 2003, 4, 5 cycle phase. And ultimately, gold rallied more than 700% from these levels, hypothetically, to get into the peak in 2011. So if we were to look at the average price, about 10,000 here on this gold or metals trend index, and say that this is our 2002, 3, 4 cycle, we're looking at maybe 60 to 70,000 as an upward peak in 2028, 29 for metals. Metals now become a very active hedge as the markets are devaluing and restructuring, looking for an equilibrium that the Fed has distorted over the past 8, 9, 10 years. The MENT Rotational Modeling system is safely hedging against all of these risks. We have continued to stay in a weekly basis bullish on the SPY, which we allocate 25% of our allocation to. Daily SPY, we've been bearish, which we allocate 75% of our allocation to. That puts us into a net bearish position for 50% of our allocation and a cash position for the other 50% of the allocation. The MENT Rotational Modeling system is what I use as the core element for institutional or 401k or retired individuals, showing us where the opportunity is in the market. Watch my other videos, because I believe we're setting up a near-term wave 5 start, wave 4 end. And this will likely change over the next 5, 6 months, maybe moving back into bullish trending. But you need to be aware that I expect the next 5 years to be very similar to 2004 to, say, 2011. Just pretty much sideways rotation in the market, maybe attempting to reach some new highs in 2025, 26, 27. But I expect us to see some real consolidated trends. It's not going to be a big blowout rally, in my opinion, or a big blowout sell-off. That's going to come in 2029, 30, 31. Right now, we have to be very cautious and stay ahead of the trends, knowing where opportunity lies, hedging effectively. And again, back here, gold and silver are moving substantially higher as a hedge instrument, with potentially a 400 to 700% increase, maybe more, setting up over the next 5, 6, 7 years. Next, we have here our allocation level. This tells us how we're doing with the general markets. We are not seeing any increase in the transportation index, which means the economy is still struggling. We are seeing the mid-cap index bullish. We are seeing the Dow Jones bullish. We've seen silver move into bullish trending both daily and weekly. Gold is almost there. Crude oil is bearish. Bonds are bearish, and consumer staples have turned bullish. This is very close to a bottom type phase, in my opinion. Mid caps are moving higher because mid caps are generally more reactive to price trends. Transportation is bearish because the economy hasn't really started to reflate yet. S&P is still mixed, bearish, bullish, because we don't have any indication of a reflation yet in price trend. Dow Jones has moved higher because the blue chips tend to do fairly well regarding earnings and purchasing, regarding their ability to continue to sell. Blue chips tend to do fairly well and will recover fairly quickly. Gold and silver will move into a very strong bullish phase in an early stage recovery, typically leading the market higher by like 2 or 3 months. Oil will continue, in my opinion, to move lower, possibly moving to the $62, $63 area. Bonds will transition into bullish trending eventually. We haven't seen that yet. It'll likely happen when the Fed becomes a bit more dovish. And consumer staples perform very early in a reflation cycle, simply because consumer staples consumers will spend on items that they need. Understand that they might be spending on credit cards. They might be spending, selling juniors toys. But the idea is they still need toilet paper, toothpaste, underwear, socks. They will buy their staple products. So currently we are 20% stocks, 55% cash, 25% metals. Metals is our hedge position. We may move into bonds if we get a good trigger. Alternately, if you can't buy metals, you would be 20% stocks, 80% cash. This gives you the ability to trade a little bit with your 20% stocks, but we're mostly sitting in cash waiting for the new trigger to come up. Like I mentioned earlier, I do believe that technology, innovation, and gold and silver, as well as potentially the mid-cap and the XLP, are fairly strong opportunities for a reflation trade through the first 6-7 months of 2023. But we don't have any real triggers. You would want to follow the TT scanner triggers that I present every week, and you would also want to follow the live trades trade triggers that are on my website. If you're not a member, get over there and follow. Okay, I believe we're close to the end. This is the historical results of the MENT Rotational Modeling System. You can see last year we had kind of a flat year. Going to be very interesting to see how some of the hedge funds and other bigger investment firms actually play out. We've seen tremendous growth from 2000, from the bottom, basically. We've seen 13.5, 29.7, 11.3, 0.93. This was a flat year. 9.36, 19.38, 0.41, 19.4, 24.01, 27.07, and then another flat year. I'm expecting these years to stay moderately positive, maybe in the, let's call it 11 to 18% range going forward. But after 2025, we need to be very cautious of risks moving into 2026, 27, 28. The MENT Rotational Modeling System should be your core component for following what's actually happening in the market. Understand that this gives us the ability to protect, manage, and grow our capital extremely efficiently. And then we come over here to these charts. All right, that's the real estate update. I'm going to go off and do the MENT Rotational Modeling System update now. And I want you to be aware that we are in a transition phase from this area up here up into this 454 area. I would expect a reversion back into this 250 area. That would be a 50% decline. What is going to take? What's it going to take to do that? It's going to take a broad reduction in real estate activity, more active listings, sharper decreases to the downside, real lack of demand in the market to be able to do that. And that's likely coming over the next 12 plus months in the real estate market. We could see the Fed pivot, try to shift away from some sort of a decline. We have to be cautious that the global and U.S. real estate markets could enter into an extended decline period. This is, like I said, the most hostile period ever. Now, understand that these hostile periods, we went into a moderate recession in 2015-16, and then eventually moved into an appreciation phase over here. Then we became more hostile in 2018-19. This was just before COVID. Then we went into an appreciation phase for real estate. Now we're at the most hostile period for real estate ever. So understand that this was a broad market recession right here that led to a base bottom. Then we moved into a period where the Fed had raised interest rates and stopped quantitative easing. We hadn't pulled out of the market. The market turned sideways, went from moderate, aggressive, hostile environment to a more amenable environment. Then we went into a recessionary period here, 2015, 16, 17. And this is where the elections came into play, and the Fed was, again, stopping the quantitative easing process. Then we went into more quantitative easing and new tax laws, prompted a huge appreciation phase in real estate. Then, after the 2018 bottom, we started to move into a fairly hostile environment. Prices became extremely high. We had raising rates. You remember this in 2018-19, the Fed had raised rates to about 2.25, 2.5, and then COVID hit, and everything went back into an extreme appreciation phase, the biggest appreciation phase we've ever seen, followed by the biggest depreciation phase, hostile market environment we've ever seen over the last 20 years. The markets will revert back down into these lows. This is what's going to happen. This extreme level means that we're going to end up kind of in this area somewhere, in this lower green-blue area, which puts us in this 200 to 250 area, which is essentially a 50 to 60% decline. If it becomes aggressive, we could see the Fed move the markets back down into this area, but this would represent a 35 to 40%, maybe more, decrease in average price level from 370,000 roughly. Do the math. That's about 37,000 per. So that would be about 120 to 160,000 lower. That puts us down in this 200,000 range, right back over here, right in 200, 225. And that's where I think we're going to find some sort of a base. It may not come for the next 2 or 3 years. It might be more like 2026, 27, 28, but it's eventually coming. The hostile environment that we're dealing with right now will continue to put pricing and demand pressure on the real estate market. That's just the way it works. Okay, guys, that's it for now. Follow me and share with your friends. Talk to you later.